Okay, thanks. For this exercise here, we'll be doing some more review regarding to the reporting and analyzing of the receivables. And this exercise, we're going to take a look at Lee Limited with a bunch of transactions, and then we're going to take a look at how we're going to journalize these transactions relating to that company. So let's take a look at the transaction, perhaps one at a time. So the first transaction is on January the 1st. They said they loaned Emily Collins, an employee, $6,000 on a 4-month, 8% note. Interest is due at maturity. So in this case here, we are talking about a note that would be signed with the employee to be collected at some point in the future. It's a 4-month note, and then there will be interest involved as well. So the first entry, let's just look at the entry one thing at a time. So the first entry that we needed to account for would be to debit. So on January the 1st, we'll need to debit notes receivables for Collins. And it will be crediting cash because we're paying out cash to lend the money to Jones for $6,000 and $6,000. Okay, let's take a look at the second transaction here. On January the 5th, they sold $8,000 worth of merchandise to Assist Limited, and they have a term of net 15 days. The merchandise cost $4,800. So this is a sale, and they also give you the cost of the merchandise. So typically speaking, you would have to record both the sales side and the cost side of this transaction. So on January the 5th, you will be debiting the accounts receivables for Assist, and the amount is $8,000, and you would credit sales for $8,000, and you also need to account for the cost of the products. So the cost of goods sold, you debit cost of goods sold, and the cost is $4,800, and you would credit the inventory for $4,800. Going to the next transaction. On January the 20th, they accepted Assist Limited 2-month 9% $8,000 note for its balance due. Interest is due monthly. So basically, rather than giving them a term now, then he actually signed a note, which is bearing a 9% interest, and it would be due. The interest is due monthly. It's a 2-month note. So I need to convert this receivables now into a notes receivables. So on this transaction here, I would now this is on January the 20th, I will now need to debit the notes receivable from Assist because I'm converting this accounts receivable into the notes receivable. So for the $8,000, and I'm going to credit my accounts receivable Okay, just moving on. The next transaction deals with they collected the interest on the Assist note. This is to do with the sorry, I'm just jumping one ahead. On February the 18th, they sold $4,000 of merchandise costing $2,400 to Swaim Corporation. They accepted Swaim's 6-month 7% note in payment. Interest is due at maturity. So they are selling some more stuff to another customer. The way they're paying it is through a note. So we'd have to account it accordingly as well. So in this case, on February the 18th, I would have to debit the notes receivable from Swain Corporation, and it's $4,000. And I would credit sales for $4,000. And then I need to account for the cost of goods sold as well, because I have to match the sale here. So the cost of goods sold, as they indicated to you, is $2,400. And then my inventory, I'm crediting inventory of $2,400. The next transaction is February the 20th. They collected the interest on the assist note. So now we have to calculate the interest. And interest is paid monthly by him. So this is February the 20th. So they have received the cash for the interest, and you will be crediting the interest revenue. And remember, the amount that outstanding is for $8,000. So you would take $8,000, which is the notes receivable outstanding, and the interest rate is 9%, and it's based on 1 month because they are paid monthly. So the amount that would be accounted for is $60. So let's move on to March 20th, which is the next transaction here. They collected the principal and interest for the month on the assist note. So this is something, now they have collected everything from assist, including the last month of the interest as well. So on March 20th, they will receive cash, which consists of the note of $8,000 plus the 1 month note of $60 on the interest. So they have a total of $60 on the cash, and you will be crediting the notes receivable of $8,000 and crediting the interest revenue for the $60. And on May 1st, they received payment in full from Emily Collins. So this is the employee they have lent the money to. And this is a 4-month note as well. So let's take a look at May 1st. So you would debit cash now, and remember that the cash would consist of both the notes receivable that she owes plus the interest that she owes, and it's a 4-month interest. The notes are $6,000, and the interest rate for that particular note, it's based on 8%. 8%. So we would be debiting notes receivable, and we would be debiting the interest. And the interest revenue would be based on $6,000 multiplied by 8% and multiplied by 4 months. So the notes is $6,000 and the interest would be $160. So my total cash is $61.60 that I'll be receiving on this transaction here. Going back to the question for May 25th. So on May 25th, they accepted Avery's 3-month 8% $3,000 note in settlement of a past due balance on account. Interest is due at maturity. So this is something a customer cannot pay them, so they wanted to, they are moving into a note which would charge 8% interest. So again, we are converting from a receivables into a accounts receivables into a notes receivable in this case. And it's worth $3,000. So on May 25th, I will be debiting my notes receivable for Avery, and I'll be crediting my accounts receivables from Avery, which is worth $3,000 and $3,000. On August the 18th, they received payment in full from SWAM Corporation and its note that are due. And remember that SWAM basically had a $4,000 note and a 7% interest. So this is August the 18th. Again, you would debit cash because you'll be receiving cash, and the cash would consist of both the payment of the notes receivable and the interest. Okay, the interest will be based on, the note was actually for $4,000 and it's 7% interest, and they have gone from February to August, so it's worth 6 months worth of interest. So the total notes receivable I'm trying to pay off is $4,000 and the interest is $140. So my total amount of cash I'll be receiving is $41.40. So if you can take a look at the next transaction, which is August the 25th. And on August the 25th, the Avery note was dishonored. Eventual payment is not expected. So basically, that $3,000 note that was actually converted from the accounts receivable from Avery is now no longer collectible. So you have to write off those notes receivables now. So if this is the case, you would have to take it to the allowance for doubtful accounts. You've got to take money out of there for the actual write-off because it's deemed to be uncollectible now. So it would be on August the 25th. We have the allowance for doubtful accounts, which is worth $3,000, and I would write off that notes, which is $3,000. And the very last transaction, they have asked you that to adjust any accrued interest at year end. Since all of the notes receivables and receivables have been collected, there's no accrued interest that's actually remaining. So that's why there's no entry that's being required. Again, this concludes the discussion for this exercise, and thank you.